I'm going to present a paper on the impact of the coronavirus lockdown on mental health that draws from data from the United States. And this is joint work with Abby Adams-Prassel from the University of Oxford, Teodora Boneva from the University of Zurich, and Christopher Rao. So the motivation behind this paper is pretty obvious, but let me just quickly go through it. So since the discovery of the novel coronavirus in 2019, the virus has spread around the world at unprecedented and alarming speed, which has led many governments around the world to introduce unprecedented measures that were limiting people's ability to leave their homes in the hope of containing the spread of the virus. This was the case in the United States as well, and the lockdowns started being introduced in the month of March. Now, the lockdowns have brought about severe disruptions and changes to people's lives. So first of all, they have limited the amount of social contacts that people could have. They've also changed the way in which people could perform their job, with many people actually not being able to perform their work at all from home, and others being severely affected in terms of the way they went about their daily lives. And the lockdowns also introduced uncertainty with regards to when the measures would be eased, and they have caused financial difficulties for people that have suffered earning losses. All these factors are likely to have affected the mental health of the general population. And so in this paper, this is exactly the question that we try to answer. We ask, what are the mental health impacts of lockdown measures that were introduced to contain the spread of the virus? And furthermore, we analyze whether these effects were different between men and women. The focus of this paper is the United States, where the decision to introduce lockdowns was taken at the state level, not at the federal level. And therefore, we can exploit differences in the timing of the introduction of these measures. This is different from what happened, for example, in the UK, where the announcement of the lockdown was made by the central government and the measure applied to the country uniformly. In the paper, we use three main sources of data that give us different sets of information. So the main data source that we rely on is real-time survey data, which we collected as part of a broader project, the COVID Inequality Project. And we collected three survey waves in the United States around March, April, and May 2020, respectively, with a total of around 12,000 respondents, so roughly 4,000 respondents per wave. Now, the aim of the broader project was to document the impact of COVID-19 on the labor market. Therefore, our data comes from the economically active population in the US. So to be eligible to participate, respondents had to be aged 18 or above. They had to be resident in the United States, and they had to have been in paid work at some point during the previous 12 months prior to the data collection. For each survey wave, we choose to sample a geographically representative group of respondents, where geographically representative means that we matched the distribution of the adult population in the US across groups of states. In the survey, we collect quite detailed information on the mental health of respondents, but also their current employment situation. We have information on the characteristics of people's jobs, either their main job if they're currently employed, or the last job that people have been employed under. And we also have some information on time use, so the time that people dedicate to different activities in the week prior to the data collection. To measure mental health, we administer a 5-question module from the World Health Organization that has been used in a variety of settings and has been validated as a good tool to screen, for example, for depression. The module consists of 5 questions asking the respondent for the frequency of different feelings over the 2 weeks prior to the survey. And in particular, the feelings that people are asked about are all positive feelings. Answers are expressed on a Likert scale from 0 to 5, where 0 indicates absence of these positive feelings, and 5 means that the respondent has experienced the feelings all the time. So higher numbers correspond to better mental health. Because the 5 questions are capturing different facets of mental health, an overall indicator is constructed by summing the answers to these questions. And in the rest of the presentation, I'll give you results that refer to the standardized mental health score. So within each wave, we standardize the score to have mean 0 and standard deviation of 1. The other data sources that we use give us information on the type of policies that various states in the US implemented to tackle the spread of COVID, and information on the severity of the health crisis. For the first set of information, we rely on a publicly available repository that lists all the measures that were adopted and the date in which they were adopted at the state level in response to COVID-19. In particular, we focus on one specific set of measures, which is the introduction of stay-at-home orders. These are essentially orders that prohibit people from, that order people to stay at home unless they have exceptional circumstances. And we construct a variable that takes value 1 if the state where the respondent is living in has a lockdown order in place at the time the data collection was launched. Note that the measures that we consider are orders or directives that apply to the whole state. So they're not measures applied at the county level, but rather they're statewide stay-at-home orders. And I'll refer to stay-at-home orders and lockdowns interchangeably. The final data source is a repository on county level information on the cumulative number of confirmed COVID-19 cases and deaths, in which we match with information on the county of residency of the respondent. Just to give you a little bit of context and how the situation was when we launched our different survey waves, in the United States, the first confirmed case of COVID-19 was reported towards the end of January, and things started changing pretty rapidly, pretty quickly. Around the end of March, there were already 100,000 deaths because of COVID that were confirmed. And in March, governments at different levels started introducing measures to combat the spread of the virus and the negative economic shock. So for example, on the 19th of March, California was the first state that introduced statewide lockdown, and other states followed suit. So when we launched our first survey wave towards the end of March, 14 states had implemented stay-at-home orders. By the time we ran our April survey wave, the number of states that had lockdowns in place was 40. And when we ran our third survey wave towards the end of March, the situation had started improving. So quite a few states had already started to either ease or actually entirely lift their restrictions. Most of our results will focus on the April survey waves, which is when essentially the majority of states had implemented some sort of restrictions, and the restrictions had been in place for a couple of weeks already. The first thing that we do in the paper is we analyze the impact of living in a state that has a stay-at-home order in place on the self-reported mental health of the respondents. So here, if we look at this graph, if we look at the top coefficient, the coefficient refers to regressions on the full sample, where we regress the standardized mental health score on a lockdown dummy. And we additionally control for individual characteristics like age in bin, household income, having a university degree, being female, and being single. And what we find is that individuals who live in a state that had stay-at-home orders in place score 0.08 standard deviations lower on their mental health indicator. Now, when running this analysis, one may be concerned that states might be different in the baseline levels of mental health already before the crisis. And therefore, what we're picking up here with the lockdown coefficient is not necessarily the effect of introducing a lockdown, but rather we are capturing differences in mental health across states. So to tackle this concern, we do two things. First, we restrict the April sample to respondents that were living in states that back in March did not have restrictions in place. So in some sense, we exclude the early lockdown adopters. And we compare the mental health of people living in states that by April had introduced a lockdown and to the mental health of people living in states that didn't. What we find is, again, a negative effect of lockdowns showing up on the mental health of people in April in this restricted sample. And the coefficient is actually pretty similar to the one estimated on the full sample. Second, we use our March survey wave to run a placebo exercise where we again apply the same restriction. So we restrict the sample to individuals living in states that did not have lockdowns in place in March, and look at whether the future introduction of a lockdown is predictive of differences in mental health. And we find that this is not the case. So states that did and did not introduce lockdowns in April were not significantly different in terms of baseline mental health back in March. Now, the literature has on the impact of other economic recessions and crisis episodes has shown that these episodes can affect the mental health of men and women differently. So in the paper, we investigate whether this is the case also for COVID-19 and the lockdown measures that were introduced. So in this graph, I'm showing you unconditional average mental health of men on the left and women on the right for respondents to our April survey wave, further distinguishing between people who live in states that had a lockdown in place and those where no lockdowns was in place. So if we focus on the gray bars that look at people that were not in lockdown, we can see already a pretty large gender gap in mental health between men and women. If we move on to look at the blue bars, we see that this gender gap is actually larger for those living in states that were under lockdown. So whilst lockdowns did not affect significantly the mental health of men, they lowered the mental health of women. These unconditional results are actually confirmed when we move on to a regression framework, where again, we control for the same set of individual characteristics. And the first coefficient refers to estimation on the full sample, which I've discussed before, whereas the red and blue coefficient refer to regressions carried out on the subsamples of women and men separately. And what we can see is that the negative effect of lockdown policies is entirely driven by women. The mental health score of women that live in a state under lockdown is 0.12 standard deviation lower than the mental health of women living in states that did not have a lockdown in place. Lockdowns are instead not affecting the mental health of men. Put differently, when we want to quantify the effect of lockdowns on the gender gap in mental health, we run a regression where the main independent variables are a female dummy, a lockdown dummy, and an interaction between the two variables. And we find that at baseline, the gender gap in mental health is around 0.20 standard deviations. And it grows by an additional 0.13 standard deviations, so roughly 61%, for states that had lockdowns in place. And this is a sizable increase. The last thing that we do in the paper is we try to understand which mechanisms could be behind the negative effects that we find. So what we know about the COVID crisis is that it had wider impacts. The lockdown measures had wider impacts on the labor market, and these impacts were actually different by gender. So using the same data in an accompanying paper, we show that women in the US were more likely to have lost their job. We also find that there are large economic shocks in terms of people earning less money because of COVID-19. And so these are all things that we control for, and we see whether the increased financial difficulties, we check whether these increased financial difficulties could explain the decline in people's mental health. The second thing that we control for is variables related to additional childcare responsibilities, namely the number of hours that people report spending on childcare activities, presence of children in the household, and an indicator for whether people had to change their work patterns to adjust for these additional responsibilities that came about with lockdown measures. And finally, there are large differences in the US in the severity of the health crisis across local areas. So we control for the number of cases, COVID cases and deaths per capita at the county level in the county where the respondent is living. In this table, I'm showing you regressions carried out on the subsample of women respondents, where the first column shows you the coefficient of the lockdown dummy when we only control for individual characteristics. And in columns 2 to 6, I'm adding different variables capturing the various mechanisms that I just discussed before. So in column 2, we additionally control for realized labor market impacts, namely if someone has lost their job between February and the date of data collection, whether they report having earned less, worked fewer hours, or whether they've had difficulties paying their usual bills and expenses. In column 3, I control for childcare related variables, so the time spent on homeschooling and childcare activities on an average day in the week before the data collection, the number of children, and an indicator for having to adjust or change work patterns. In columns 4 and 5, I control for the number of cases and deaths at the county level per capita. And in column 6, I control for all these mechanisms in the same specification. What we can see going from column 1 to column 6 is that the coefficient of the lockdown dummy decreases somewhat, but still remains pretty large and significant when we control for all these this battery of realized impacts. This suggests that the realized impacts of COVID-19 cannot entirely explain the decline in mental health associated to the introduction of lockdown measures. So there is really something else that may be driving the decline in subjective well-being. When we run the same regressions on men, we don't find any significant change in the lockdown coefficient, which remains always small and insignificant. So to conclude, in this paper, we show that statewide stay-at-home orders have large and negative impacts on the mental health of women, but not that of men. And this contributes to a widening of an already large gender gap in mental health scores across genders. We also show that these negative effects are not entirely explained by the severity of the health crisis at the local level or by increased financial difficulties or additional stress due to childcare responsibilities. So if we were to speculate on what could be driving the effects that we find, there are other studies that suggest that the loss of social interaction and increased loneliness are really important mechanisms that have affected people's well-being. And to conclude, in terms of policy implications, what our paper suggests is that the health costs of lockdown measures are large and the health costs of COVID-19 go beyond the number of cases and deaths. And the mental health costs of COVID might actually be felt for quite a while into the future. So it is important to direct resources to programs that provide support to people that are suffering and for individuals that are at risk. And in terms of what we can do to minimize the negative mental health costs of the current situation, I think it is important to promote social interactions in a safe way, so potentially online. And more research should go into understanding what activities or what type of policies we can implement that could help contain the widening of the mental health gap. Thank you very much. And I'm leaving here the link to the COVID Inequality Project webpage in case you want to know more about our other results. Thank you.
Well, Marta, thank you very much. There was already a lively discussion in the chat. I'm not sure how we handle this when we later turn to the questions and answer session. But now first we have a discussant, Paolo Pinotti. Very glad you discussed this paper, and the floor is yours.
Okay, thanks a lot. Yeah. Can you see my slides now?
Yes.
Yeah. So thanks for the invitation to this interesting event, and I'm particularly happy to discuss this paper because actually Marta was one of my very first students at Bocconi University, unfortunately for her, but fortunately for me, so I can see her growing up as a great researcher and writing great papers. So yeah, just a quick summary of the paper. Well, it estimates the effect of lockdown measures across US states using a novel representative survey of about 20,000 respondents in 3 ways, just at the very beginning, I would say, of the COVID pandemics and the policy response to such pandemics. And just to summarize the results, the lockdown results into a significant decline in mental health, so about 0.08 standard deviation. So I'm not very used to these measures. So at the beginning, I thought, okay, maybe it's not such a large effect. But then in the paper, they discussed that in comparison, for instance, unemployment is associated to a 0.16 standard deviation decrease. And so, I mean, this is quite a large effect at the individual level. And the effect is driven by women. However, it's not related to one of, I would say, usual suspect explanations like childcare responsibilities during the lockdown with schools closed. And maybe I will have something to say about that. But before, let me comment a bit on the survey first. So the main source of data, which is also, again, one of the novel aspects of the paper presenting this new data. So this is a sample of participants to the labor market. So I wonder a bit about the external validity of these results for retired workers and students. I mean, they are not included in the survey. I mean, you always need to, you always choose a sample frame, and then you're going to miss some people. But I guess students and people retired from the labor market, they would be particularly important when you, in opposite directions, actually, when you think about the consequences of lockdown measures. So I wonder whether, I don't know, there could be an attempt in the future to also cover these groups. There's a clear overrepresentation of women and college educated in the survey. So they show that the results are robust to reweighting in order to make the share of women college educated equal to the one in the census. But still, I'm wondering why is that? I mean, if they have a reason for that, so could it be a differential response rate? So maybe they first try to interview 50% of males and females, but then males were not responding. There was attrition, and same for people with lower education. And finally, about the data, I actually found the presentation much more clear in terms of discussing the main dependent variables, this 5 questions model from WHO, which is basically not discussed in the paper. So I would add a longer explanation in the paper. About the results, actually they present estimates for the different waves, and as Marta explained, they take the main results, they come from the April wave. In the appendix, they show a table in which they estimate an equation putting together all waves and including state fixed effects. To me, this would seem the most natural specification. So I wonder why not using this as the baseline equation. However, I have to say the results are very similar when you use this pool specification with state fixed effect and when you just include the April wave. So that's okay. It's probably just a matter of taste. I wonder whether you could allow for non-linearities in the number of days. So the main explanatory variable is a dummy 1 if you have a lockdown and 0 if you have not. In one specification, they control for the number of days, but this is fully linear, right? So I think you have two important non-linearities. The first one is that, the effect maybe could jump when you have 0, from when you have 0 days of lockdown to when you have even just a few days of lockdown. I guess the effect there could be very nonlinear. And the second nonlinearity is the effect could be convex or concave in the number of days. Okay, so I read also the previous interactions with the referees. So you also presented some result with some beans by number of days. You don't find very significant differences, but there was a pattern, and I think the specification with a number of beans is very requiring in terms of power. So I think just including a polynomial with the square number of days would maybe be more efficient and resulting into a significant curvature of the effect. There's also an additional intensive margin. So what about the severity or the type of restriction? You just talk about lockdown, but I'm not very familiar with measures across your states, but if you think about lockdown measures in Europe, they mean very different things in Germany versus Italy versus France. So I wonder whether there is some heterogeneity in the type of measures that you could discuss. And in any event, I would discuss and provide more descriptives about the timing and the severity of this restriction. And even in this respect, I think the presentation was actually better. So you show this timeline from the first case to the first death to the introduction of this measure. And this is absent in the paper. And instead, I think it would be very useful. Very last comments. So in the end, we are left with the, with the issue of what is really driving the stronger effect for women. So you show in the last specification, in one of the last tables, that the fact that that females, that they have children or not, doesn't really make a difference for mental health, but you don't interact the fact of having children with lockdown measures, right? So I guess what you would really like to estimate is whether the lockdown had a different effect for females with children and without children, and the same for males, probably. So it would be a sort of a triple interaction. So rather than doing a triple interaction, I think it's fine to keep the separate sample as you do, females and males. But again, just including whether you have children or not is not going to capture the severity of the effect of lockdown measures, the differential effect for people with or without children, which I think it's what is very relevant here, right? And then finally, I think there are other dimensions of heterogeneity that you could potentially explore with this data in terms of age, education, and also especially type of job, right? So whether I have a very stable contract in the public sector, or whether I have a more risky contract in the private sector, I guess these two types of people, of workers, since your survey is really about workers, could have very different consequences from the lockdown in terms of mental health. But again, great paper. I think there are here also some interesting direction for future research. So what about longer term effects? So as I said, the 3 ways they were conducted right after the introduction of these measures. Now, it's more than 1 year that we are in this situation. So it would be useful to check the longer terms effect, whether you plan to do something like that also across countries. And then finally, I wonder whether you had some information about use of social media, the intensity in the use of social media. I mean, I read some books from, neuropsychologists that actually claim that, social media can cause depression, especially in women and in females. And I guess whether, we have probably all been using these devices more during the lockdown, and probably this could be a reason for the effect. And then, yeah, in the chat, I saw there was a lot of discussion about, if you want, the endogeneity of these lockdown measures. I mean, I was, of course, there's an issue there. I think that by controlling by the number of deaths and the number of cases, you try to sort this out. Some people in the chat propose using intensive care units. I guess the lag between cases, intensive care units is about half of the lag you have with deaths or something like that. So I think by including deaths and number of cases at the state level, from what I understood in the paper, you're kind of taking care of that. But yeah, I leave you answer to that, of course. But again, very interesting paper. Thanks a lot.
Thank you very much.
Okay, cool. Thank you very much. And we have a second discussant of this paper, Christopher Roth. Christopher, the floor is yours.
You're muted, right?
Yeah, the microphone.
Chris? Chris, you're mute.
Oh, okay. Okay, well, then I should repeat everything I just said. Okay, well, thanks to the organizers for inviting me to be discussant for this paper. I really enjoyed reading this paper, and yeah, let me jump into the summary of the paper. So the authors employ tailored real-time surveys on mental health to study how stay-at-home orders affected mental health, and they leverage repeated cross-sections and exploit state-level variation in those stay-at-home orders. And the authors establish significant decreases in mental health that are entirely driven by women, and therefore these stay-at-home orders strongly increase the gender gap in mental health. So let me first start by saying what I really like about the paper. So the authors tackle a really important question. Mental health during the pandemic is an extremely important topic, and one can, assume that a lot of the weight of, a lot of the welfare losses, incurred in the pandemic have to do with mental health. And so mental health is of key importance for policymakers. Firstly, because it should be a key welfare target of interest for governments around the world, and many governments take mental health measures very seriously as a measure of welfare. Second, because low mental health can trigger mental illness and suicidal behavior or other types of mental illness. And then, thinking a little bit, through the lens of an economist, it can also lower productivity. So there's like very strong evidence that, low mental health lowers productivity. So, it has really large economic and health and social costs. So what is great about the paper, let me just emphasize this. So the authors pioneer the use of real-time surveys in order to measure the immediate welfare impact of policies. So the idea that, as economists, we will be able to immediately measure welfare impacts of things happening in the world, I mean, it's pretty incredible. I mean, I think 20 years ago, this would not have been possible, I guess, with new technologies and these online survey technologies, it is now possible to actually have these real-time evaluations, and the authors have, in a series of other papers done great impacts. And I think just want to emphasize that this is incredibly useful for conducting policy in real time. So their approach, allows us to quantify not only average welfare effects, but to also look at interesting distributional aspects of these shocks. And therefore, their shock can be quite useful for informing policies, mitigating the adverse health consequences. And it could also inform optimal targeting of government aid programs. All right. So my substantive discussion will center surrounding discussion of mechanisms. So basically, the authors outline that these stay-at-home orders can result in contact reductions, increased childcare responsibilities, job loss, and income uncertainty, and increases in the perceived severity of the pandemic. Basically, if you learn that there's a stay-at-home order, you might take the pandemic more seriously than otherwise. And so, this is a pretty bad combination of shocks if you think about it. Both an economic shock and reduction of social interaction. So it's really a combination of things that have been shown to really have big impacts on mental health. So we have really clean evidence on income shocks and mental health. We have good deal of evidence on how social interactions affect mental health. So taken together, this implies that this is a really important and potentially huge shock for mental health. So of course, the interesting angle of the paper surrounds basically, the gender differences. And as we know from the work of the authors, women are more likely to have lost their job during the coronavirus pandemic. So it's a very, I guess, an unusual, recession. And, the authors focus on this mechanism as well as the childcare responsibility mechanism. So women also bear a higher burden regarding childcare responsibilities, as has been shown by recent work also from the authors and other independent work. So there's two other basically more gendered impacts that could be going on, that could be driving the differential effects between men and women. So women might be more affected by contact reductions through stay-at-home orders, as they are more likely to comply with stay-at-home orders. So there's some evidence that women, well, they actually stick to the orders more than men. And so, that could just mean that the effect of social interactions could, the reduction in contacts could be driving some of this gap. Moreover, women take the pandemic more seriously. So when asked, how big of a threat the pandemic was, women perceived it to be a bigger threat. And of course, this is consistent with other evidence out there on gender differences in risk preferences. Okay. So this is basically saying, there's other mechanisms that the authors, just can't test for because I guess they may not have data on these things, but they may be worthwhile discussing a little bit, even in the absence of evidence. And there's more of an econometric question, which is, it's a little bit of an open question, I guess, in general. How do economics papers test for mechanisms? So the usual approach is to conduct a mediation analysis along the lines of what the authors did. And so basically what that means is that the authors throw in endogenous controls in their main specification, and then they see how the coefficient moves in response to these controls. And the authors show that by and large, the coefficient doesn't change much. And I think this is the standard way of testing for mechanisms. This is, I guess, what every good paper in this literature would do as one test. So I think there are though two possible alternative strategies to explore mechanisms. So Schwand, Pai, and Pischke basically have a paper that argues that noisily measured control variables are potentially more useful on the left-hand side than on the right-hand side. So they argue basically that if your control variable is measured a lot, then we shouldn't measured with a lot of error, then we shouldn't be surprised that it doesn't soak up too much variation. And so in some sense, some of the control variables that the authors put in, they are on 5-point Likert scales, and basically variables that are potentially prone to measurement error. And so if we take the Schwand-Pai-Pischke view, we would say, well, let's just put them in as left-hand side variables, you know, basically using the same specification as the authors use in order to study the main outcomes, and then just see whether they are moved. So this might, you know, yield a slightly, you know, different interpretation of whether these mechanisms are going on or not. Then finally, there's really cool work by Gillen, Snowberg, and Yarif, which suggests that there's other ways to deal with the measurement error in control variables, which use basically IV methods and leverage multiple measurements. So the idea is that you can instrument your control variables in your main specifications if you measure these control variables in multiple ways. And so, for example, the authors in the paper measure the income shock and the financial shock, you know, in multiple ways. And, you know, they might, you know, it might be useful, you know, as a robustness check to see, you know, whether these types of methods by Gillen, Snowberg, Yarif might help them deal with some issues in measurement error and the control variables. I mean, these are just two possible alternative strategies to explore mechanisms. I think what the authors did is the most standard thing and makes a lot of sense. Okay, so one question that I thought was interesting, which I mean is beyond the scope of the paper, but you know I thought, you know, I mean I'll still mention it briefly. So of course we do worry a lot about you know, suicidal behavior resulting from depression and like low mental health, and there's the question whether men and women were differentially affected in their inclination to commit suicides by stay-at-home orders, and you know, similarly, you know, other minority groups. You know, we all know that the pandemic hit, you know, racial minorities particularly, you know, hard. And so it would be interesting, you know, to basically dig up the CDC-based suicide data, you know, which is around at the county level and which gives you exact date of death, gender, race, age, and zip code of residence. I think, to be honest, that data probably isn't out there right now. I mean, usually there's quite some lag with the CDC, but well, once the data is out in a few months or years, it will be interesting to see whether these effects on these survey-based measures carry over into, you know, I guess, outcomes that are particularly, you know, I mean, well, sad and you know, I mean, at the lower end of the mental health distribution. So in the chat there was a lot of comments surrounding the endogeneity of the stay-at-home orders. I thought that the placebo in some sense and the kind of table B3 that Paolo also mentioned, which used the state level diff and diff in the end, were quite convincing. So I was personally convinced by all of the robustness checks, and I believed in, you know, the credibility of the identification. But I guess we will be able to discuss that now.
Thank you very much, both, for the great comments. I see that there are also quite a lot of comments in the chat. So maybe I can start like very quickly picking up on a couple of things that were mentioned. And then if there are more questions that come up, I'm also happy to take those. So one thing that I should have probably clarified a little bit more relates to the data. So how we chose the sample. The surveys were conducted through an online professional survey company and relying essentially on their panel. And as Paolo was mentioning, the samples are slightly different from the population in the US, in that we are surveying more women, younger respondents. This is probably due to the nature of the way in which we collected the data, which is through online surveys. One thing that was mentioned was the fact that we're not able to look at the mental health effects on students and people who are retired. I agree, this is quite an interesting group. Both of these are interesting groups to look at. However, we don't have enough people in our sample, essentially because of the data restrictions that we impose, which is that people need to have been in work. So, but I agree that that it would be interesting to look at those groups as well. In terms of mechanisms, thank you very much, Chris, for the references to these other papers and potential ways to test for mechanisms. One thing that we did in sort of the other papers that came out from this data is to show that some of the things that we control for are actually going on because of the crisis. So in some sense, results from these other papers are a bit of a way to put the mechanisms on the left-hand side. And there we show that, for example, women were more likely to have lost their job. They were more likely to have to spend more hours on childcare duties relative to men. So some of the things are kind of highlighted there, but we can definitely think about implementing more of this. And then I think in the chat, from what I can see, there were quite a few questions on controlling for the endogeneity of the lockdown measures by essentially trying to control for cases and deaths. What we do in the paper is we control for the number of cases and deaths at the county level as opposed to the state level, mostly because the county can be thought as a more directly relevant dimension for the individual. So for example, I always look up the number of cases in Oxfordshire to know whether it's safe or not to go to the supermarket. So this is something that is kind of directly affecting people's lives and maybe behavior. But we can also add the different specifications where we control for the number of cases and deaths per capita at the state level. And I think information on ICU is, we don't have it in the data right now, but again, we're controlling for both cases and deaths. So it's, the lag would likely be covered there, or I mean, the measures would be highly correlated anyway. I have lost track of the questions. So someone is asking whether the results can be explained by differential stigma attached with discussing mental health problems. So this is a really interesting point, and I think it's more broadly related to how men and women essentially use also the scale of mental, the Likert scale when answering these types of questions, and whether women are more likely to express negative mental health feelings. I don't have a clear answer to that, in the sense that there are other papers that document quite large gender gaps in mental health. So the gender gaps that we find are consistent with other studies. We don't know whether this is because there is a different use of the scale that people make across gender, but it is possible. However, we do look at essentially changes in mental health due to the lockdown. So one would need to think that the lockdown, the effect of the changes of the effect of the lockdown on changes in mental health is due to different use of the scale between men and women, and that is somewhat less likely maybe to hold. There is also another question on Gallup data. Trying to get access to Gallup data that has been running daily surveys about the economic and non-economic effect of COVID-19 in the US. Yes, this is, they definitely have.
Later, maybe, it's okay.
Oh, okay, perfect, then. There was a comment by Paul, I think, on the non-linearities of so essentially non-linearities in the effect of being in lockdown. We tried to control, to do some analysis that could tell us something about that. One thing that we're a bit limited in is that we only observe essentially the same person, or that we only observe people that one point in time. So there is not a huge amount of variation that we can exploit in the number of days that people have been exposed to lockdowns, which is also why we focus on the April survey wave, where more people had been in lockdown for sort of different amounts of times. But yeah, we tried to run a specification where we added days in lockdown in bins, and we found evidences of a convex effect, meaning the longer people are in lockdown, the larger the mental health effects. This is still relevant for sort of early lockdown times, in that I think the longest we observe people being in lockdown in April is something like 20 days. You can think about some adaptation effect kicking in later on. And in fact, I think other data from the UK, for example, shows that people's mental health or subjective well-being started to recover after a few weeks that they have been in lockdown. So there might be a convexity at the beginning and then sort of plateauing and even reversal of the effect, if you want, towards the end.
Okay.
Yeah. I'm conscious of time, so.
Thank you very much. This is a challenging task, actually. Lots of comments coming in during your talk. There are also 4 persons who actually just followed the rules and said they had a question and want to articulate this question. I feel it would be unfair, unjust not to give them the opportunity to raise their question, even though this will bring us into 5 minutes of overtime. So the persons are Valeria, Christina, Ghazala, and Dennis. So maybe we can collect these 4 questions and return them to you and then have a very, very short coffee break. Valeria, please.
My question was actually already addressed during the chat, so I'm fine.
Lovely, thanks. Christina.
Yep. My question was also addressed partially, so I would be interested in whether there's evidence in the literature on how predictive this health meta score is for different, in terms of personal characteristics, not only gender, but also for older or younger people, given that it's at the base, the baseline is a measure of your paper.
Let's collect, then the next would be Ghazala.
So I was also thinking that in order to understand these gendered effects, so you focus on children, which makes absolute sense, but I was wondering whether you could also look at looking after things like older family members, parents, which there may also be a gender difference there. And it might be difficult with the survey, but maybe by looking at the age so looking at some heterogeneity by age. So that was one question, and very briefly, but I think it came up in the chat, which is whether you have measures on whether people were actually seeking medical help. So whether there have been changes in that as well. That's it.
Okay, thanks. And 2 last questions by Dennis, and the very last question by Charles. Dennis.
Yeah, hi. I have a very simple question. So you look at 3 waves, but there's actually different people in each wave. So this is not a panel in that sense. And I was wondering whether you're concerned about basic sample selection issues, that once COVID hits, some people might have lost their jobs, or they sign up for the survey to earn money, or any considerations along those lines. I think that's important.
Okay, Charles Wyplosz.
2 questions. There is quite a bit of evidence that people have locked themselves down before getting orders. So there is a question of what is it that you measure exactly? Is it being isolated, or is it being under orders? This is interesting because it relates also to compliance. We know that compliance with orders has been highly variable. And we also know that it is sometimes related to politics, including local politics. So what's happening socially at the local level, of course, has an implication on socialization. The other question is that there is a study done on very similar study done on the UK with similar results, but one difference is that economic factors didn't seem to have much of an impact of mental health in the UK and differential mental health across gender. I was wondering whether this has to do with the fact that the UK had much more encompassing policy supports than in the US. So that would be a true policy question, whether the fact that the US didn't do what we did in Europe had an adverse effect on mental health in general and a more adverse effect on women. Thank you.
All right. Last words to the author.
Thank you. Thank you for the questions. I'll try to answer them relatively quickly. So there were a couple of questions about, for example, care. So there was a question about caring responsibilities and whether we could look at anything beyond children. Unfortunately, we don't have information on the presence of other vulnerable people in the household or people requiring care. We control for one question, which we control for whether the person had to change their work patterns because of caring responsibilities, which is phrased in a way that is a bit more generic than just the presence of children, but that's sort of as close as we can go to kind of controlling for that. But I agree that this is a very interesting point. In terms of how mental health varies with other characteristics. So off the top of my head, I don't remember the figures exactly, but I also from our data, but in other studies as well, I think the most salient dimension where you find gender gaps is by gender, and we mostly focused on gender because of this, but also because the coronavirus crisis has had very different impacts by gender on many dimensions, including children. So this is something that we're focused on, but we can definitely present more data on sort of how mental health varies by personal characteristics. In our data, we find that that people with a university degree have higher mental health scores, that people with higher income, higher household income also score higher in the mental health scale. We don't find much in terms of heterogeneity by age groups. And we find a consistent result with other studies that being single is negatively correlated with mental health. There was also a question on whether we have information about treatment or seeking medical help. Unfortunately, we don't have data on that in the survey. So yeah, we can't answer this question, unfortunately. Finally, one thing that was mentioned is that people locked themselves down before getting orders. This is true, and it is also true that there were restrictions also at the more local areas. So for example, at the county level, that were sort of independent from what was going on at the state level. So we can think of our control group, if you want, as being a bit contaminated with treatment potentially, which makes us interpret our coefficient as potentially a lower bound of the effect if some people that we classify as not being under lockdown were in fact in isolation. But the issue of different compliance with the lockdown orders is also quite interesting. And indeed, as Chris was saying before, there's differences in compliance by gender. So we could discuss this more in the paper. And finally, I think there was one question about sample selection across different waves. So our surveys were run over a relatively short period of time. So the first one was end of March and the last one was end of May. We don't find huge differences in the observables. So we are constantly oversampling more younger people and highly educated people compared to the distribution of the population, of the characteristics in the population. We obviously find that the unemployment or the number of people without a job is slightly higher in April, consistent with the fact that also job losses were higher, but our numbers are kind of similar to the official statistics. So in that, I don't think we have a huge problem of differences in sample selection across waves. And the last point was about the economic impact being larger in the US versus the UK. It is possible that this is due to differences in policies that were implemented. In the US, there was large heterogeneity also in terms of, for example, short-time work schemes. So this is definitely an explanation. We can try to dig into that a little bit more. Thank you.
Okay, great. We had a little bit of overtime. We have now 7.
Sorry.
No, nobody's fault. Just maybe it was the fault that your talk was too interesting, but that's a risk we have to take. We have a break now, which we should start again at 2:40. That means we have only 8 minutes break to stretch and relax our eyes. See you in a few minutes. Thank you very much.
Thank you very much.
Okay, welcome back, everybody. We have now 2 papers in a row, so this means we have to be very disciplined in terms of timing. And I very much welcome Guillaume Chapelle for the second paper today on the medium-term impact of non-pharmaceutical interventions, the case of the 1918 influenza in the US cities. I'm very curious and look forward to the paper. The floor is yours.
Okay, thank you very much for the invitation and to give me the opportunity to present this paper today, which is about the medium-term impact of non-pharmaceutical intervention, exploiting the case of the 1918 influenza in USA. So first, let me start by a little bit of motivation and definition. So I'm willing to investigate what happens after in cities that implemented strong NPIs, non-pharmaceutical intervention measure in the medium term, that is after the pandemic is over and those policies have been repealed. So by non-pharmaceutical interventions, I mean any kind of policies that are meant to try to slow down the pandemic while not relying on medication or medical treatment. So these go from social distancing or school closure up to the lockdown that we just saw in the presentation before. So looking at the 1918 pandemic might be extremely interesting for the simple reason that it is far back in the past. And so we can not only investigate the impact of NPIs that were used at that time during the pandemic, but also look at what happened afterward. Of course, this is at a cost that there is a limited external validity when thinking about the current COVID-19 crisis, even though one might think that the mechanism that, in particular, the immunity mechanism that I can put forward might also have some implications for today. So to do so, to investigate the medium-term impact of NPIs, I'm gonna conduct the difference in difference estimation, looking at how the intensity of NPIs affected yearly mortality. By doing so, I'm willing to contribute to 3 main branches of the literature. The first one is the literature documenting the main drivers of urban mortality, in particular focusing on the beginning of the 20th century in US cities. The second literature that I'm willing to contribute to is a literature documenting more precisely the impact of those NPIs on the spread and on the spread of influenza and their consequences, with a broad array of papers that were provided by the epidemiologists, but also some econometric papers that contributed to this literature as well. And finally, I'm also willing to have a word on the debates that appeared about 1 year before, 1 year earlier, on the trade-off between health and the economy, and in particular, investigating the case of the 1918 pandemic. So a quick preview of my results. So I show that cities that implemented more intense NPIs might have flattened the curve during the pandemic and thus experienced a lower mortality during the main wave in autumn 1918, but then went through higher mortality level from 1919 on. So before going any further to the study, let me give you some background about the 1918 pandemic and what happened in the particular case of the US. So the 1918 Spanish flu took place from January 1918 up to 1920. And was probably one of the most dramatic events in the history of health of the past century, as 1/3 of the population got infected and had apparent illnesses, and it was extremely lethal, in particular for young people aged between 20 and 35 years old. This resulted in a very high number of fatalities, estimated between 50 and 100 million. In the US, the particular case of the US, the deadliest wave happened in autumn 1918. It was the second one. The first one was not very lethal. And this second wave started in the east of the US, probably brought back by US troops returning from World War I from Europe. And then it spread from the east to the west. And this is key in this paper because as there was no central coordination from the federal government, cities responded differently with different timing and intensity, and in particular, cities in the West responded probably more rapidly, but also more intensively, learning from the gravity of the crisis in the East, from what happened had happened in the East. So to investigate the medium-term impact of the NPIs implemented in those cities, I will rely on a panel of 43 cities for which data on NPIs were compiled by previous studies. So I will combine with alternate sources as I will digitize, for example, the table on mortality by the Census Bureau, but I will also combine this with the statistical abstract of the United States or even financial statistics provided for the city and even microdata from the decennial census. So when one is willing to measure the relationship between NPI and mortality, there are two main variables that are important and that I want to spend a little bit time and give some further detail on. So the first important variable is the dependent variable, which is data on mortality. So I will mostly focus on mortality for all causes of death, even if I'm gonna also have a look at mortality from influenza and pneumonia. Nevertheless, I prefer to the first indicator, provided that the epidemiological literature was extremely critical on the second one, stating that at that time there were many mistakes in classifying the death, and thus that excess mortality should be measured from mortality for all causes of death. I will mostly rely, because I'm willing to investigate the medium-term impacts of what happens afterward, I will mostly rely on yearly data, but I will also perform robustness checks with monthly data, and even when documenting the short-run impact of those NPIs, I will also have a look at weekly data. So as far as NPIs are concerned and their measurements, so the policy intervention, I will closely follow the literature and in particular the paper by Markel and his co-authors that produced a data set describing the implementation of 4 main categories of NPIs in those 43 cities. So among those NPIs, which is also very different from what we saw during the COVID-19 crisis, so the most important NPIs were school closures that were implemented in 41 cities out of 43 in the sample. There was also public gathering ban and isolation and quarantine procedures. And then they have also a category of other NPI where they put a very heterogeneous NPI implemented in very few cities as streetcar cleaning or ventilation, public information diffusion or staggered business hours. So from this information on the implementation of this policy, there are usually 2 main independent variables that were built. The first one is a measure of NPI intensity, which corresponds to the cumulated number of days under NPIs. This corresponds to an NPI intensity measure because 1 calendar day in which 2 different categories are applied will count twice. Then there is also the speed of implementation, which is the difference between the implementation of the first NPI in the city and the acceleration date of mortality in this city. So let me have a look on the demographics now, on the summary statistics of my sample of 43 cities. So one can note that those cities are usually typical large cities in the US with more than 100,000 inhabitants in 1910, with a relatively high population growth and an average age which is quite low, which is 28 years old. This is typical from the US of the beginning of the 20th century. As far as NPIs are concerned, the average intensity is 88 days, accumulated days ranging from 28 up to 170. And on average, the first NPI was implemented 7 days after the acceleration date of mortality in the city. So the data on mortality also provides you a flavor of the magnitude of the crisis. So mortality from influenza and pneumonia was about 200 per 100,000 inhabitants in 1917, and this figure was multiplied by 3 to reach 650 in 1918. This has a direct consequences on the second indicator, which is mortality from all cause, which was about 15 per 1,000 inhabitants. And this increased by to 20 per 1,000 inhabitants in 1918. So when to investigate the relationship between NPI and mortality, I'm gonna perform a standard event study approach or a differential approach, regressing mortality on time and year fixed effect, and then interact my NPI measures with year dummies when looking at the event study, or the post variable when I'm looking at the difference in difference framework. Then I'm also allowing for some controls. For example, I allow cities with different characteristics to have different yearly behavior interacting those fixed characteristics with time dummies. I'm also allowing to control for time varying variable as migration flow or temperature. Of course, when one is regressing NPIs on mortality, you might be concerned by several endogeneity problems. So I'm trying through the study to address three of them that can come to your mind. The first one is reverse causality. As you might think that cities that implemented more intense NPIs might be also cities that are more sensitive to the influenza. So first thing to reassure us would be to investigate pre-trends, looking whether those cities were more sensitive to past influenza epidemic or had different trend in mortality. You might also be concerned by the omitted variable bias, which is closely correlated with this issue of reverse causality. And this is a legitimate concern, as cities with stronger NPIs are also located on the West Coast and tend to be younger. So to control for the influence of those of potential confounding factors and characteristics, I will try to control for those demographic characteristics. I will also try to use more disaggregated data as mortality by age groups. And finally, I will also add regional shocks in order to only exploit within region variation in the NPI variable to identify my treatment. One might, as the end of the 1918 pandemic coincide with the end of World War I, one might be also concerned that there are sudden unobserved dynamics that happen in more aggressive cities. So I will, for example, also try to control for yearly migration flows or even temperature, and also perform a series of placebo tests on the city's characteristic or on health expenditures. And finally, one might be concerned by the measurement error, in particular in my dependent variable. And I will thus also perform placebo tests on outcomes that are from the same source, but that are less likely to be affected by the immunity mechanisms or the NPIs that I'm going to discuss when looking for the mechanism that explain my results. So a quick preview of the results. So there are two main takeaways here from those charts. So one can note that the cities that implemented more intense NPI in 1918 had a very not particular dynamics before 1918, but then went through a large rebound in their mortality with respect to the other cities from 1919. This is also true when looking at mortality from influenza and pneumonia. So then one can try to focus on first on what happened during the pandemic, and in particular during the main wave. And one can note that actually those cities initially performed much better than the other cities and had managed to flatten the epidemic curve and managed to lower the number of deaths during the main wave. However, when one extends the number of observations to include the observation after 1919 and in the month following the first wave, then the sign flips and turns positive, suggesting that in the end, those cities went through higher mortality increase and lost more lived. So to sum up, there was in cities that implemented stronger NPI, there was a lower mortality in 1918, which I estimate that about 170 lives were saved for a city with 100,000 inhabitants and implementing the average number of NPI days. But then there was a positive and significant rebound in mortality from 1919 on. And actually, I estimate that for similar cities, this corresponds to about 100 lives lost yearly. On the other hand, there is no significant impact neither in the short nor in the medium term of NPI speed. So I perform a bunch of robustness checks to try to reassure that those results are not driven by any special things. So for example, I try to look at alternate dependent variable, rates instead of log, mortality by age group. I also remove suicides. This does not affect my results. I also perform placebo tests on the city's characteristics or on causes of death unrelated with the immunity mechanism that might be at stake. As my sample is relatively small, I also perform statistical inference tests. My results remain significant. I also look at alternate timing. In particular, I look at longer pre-trend back to 908, or I also look at alternate data that has monthly data. My results remain robust. And finally, I try to control for a wide array of things that have been put forward by the literature to check as a key drivers to explain the magnitude of the 1918 epidemic, or other drivers from urban mortality. Usually, this does not affect my results. So one key question is how to interpret this significant rebound from 1919 on. So here is an epidemiological literature might help. Actually, there was probably, as I showed you, there was a flattening of the curve, in particular in October 1918, which was a time where there was the most contamination from the 1918 influenza and most of the death. So there were probably less death in those cities and probably even less contaminations. And this might explain why there's a significant rebound afterwards through two main mechanisms. The main one is the individual immunity that has been put forward by the epidemiological literature that shows that the first flu that one contracts in his life is key to determine its probability to die from subsequent flu epidemic, in particular the seasonal flu. And this might be particularly important for people afflicted by comorbidity factor, as one might think cancers or tuberculosis that was extremely widespread at that time. And this is somehow supported by my data, as I show that this rebound in mortality is supported by people that are afflicted by those comorbidity factors. Then one might also think that this key mechanism might be also complemented by a lower herd immunity, which might facilitate the circulation of the virus during the following winter, and this higher circulation of the virus might also have impact in the longer run through in utero exposure. So there is a literature that shows that in utero exposure of children during the pregnancy to influenza might have very negative impact on their development, both socioeconomic, but also on their health. And so this might, if there is a higher circulation of the virus in the following winters, then the children might suffer from this in those cities. So to conclude, the short-term benefit of NPIs might be fragile, as I show that in the medium term, that those policies, as implemented in 1918, of course, might be associated with a higher mortality level in the following years, due to probably a depressed immunity and worse health condition of the population. So in terms of policy implication, this stress the need. This does not deny their benefit in the short run to flatten the curve, but this stress also the need for clear exit strategies. Hopefully, when looking at the current crisis, the fact that we have pharmaceutical technologies much more developed might reassure us, provided that we have an exit strategy which can rely on vaccine, which can prevent those negative effects to happen. I thank you very much for your attention, and I'm really looking forward to hear your comments.
Well, thank you very much. And we move on straight to the first discussant of your paper, Claire Lim. The floor is yours.
Thank you. So thank you so much for giving me the opportunity to discuss this very interesting paper. And as usual, we are going to start with the brief summary of the contribution. So there has been lots and lots of papers looking at the influence of NPIs on various kind of outcomes, short-term and medium-term, etc. So there is much of overlap between what is going on in the literature and this paper. So let's try to sort of sort out what are the key differences. So this paper builds on the data that has been developed by this paper by Markel and others published in JAMA in 2007. And there is also quite a bit of commonality between this paper and the approaches used by Correa working paper and Barrow's working paper as well. And the primary selling points of this paper is 3 dimensions. The first contribution is that the author is looking at a longer time window compared with most of other papers written in the literature. And also he runs panel regression with the flavor of the definitive, while some papers in the literature just look at the cross-sectional dimension. And another selling point of this paper is that he broadened the measure of the mortality that is being used for the analysis, and he provides very detailed discussion of sort of advantages and disadvantages of various measures. And with this contribution in mind, let's also try to think about various concerns or room for improvement we can think of. So for most of the papers that we are looking at regarding the influence of lockdowns or more broadly NPIs, etc., the first question that comes up in our mind is the question of endogeneity. So the author provides a very clear and standard argument against endogeneity. So he checks the parallel trend assumption, and he shows that the areas with very strong NPIs and the areas without very strong NPIs had very similar trend before this pandemic of 1918 came. And he also carefully controls for a very large set of socio-demographic characteristics, and he also explores variation of NPIs within the regions. So this clear standard analysis that tries to sort of rebut endogeneity concern is very helpful. I think that there are some remaining lingering questions that we may want to address, and if the author successfully addresses those questions, I think it made the paper even more interesting. So first, I have been wondering up to page 22, what are the key predictors of the strong NPIs? So I would have wanted to see this discussion of the predictors of the strong NPIs much earlier in the paper, so that we can have more clear sense of what is the sort of geographic variation and variation in terms of demographic characteristics regarding this variation of the NPIs. So on page 22, the author provides this fairly clear description of the areas that implemented longer duration NPIs. So they are the cities with lower average age and higher population growth rates and more males, and most importantly, they are on the West Coast. So this was very helpful. And they also, he also provides a balance test between the cities with above median NPIs and below median NPIs in terms of the duration. And he also looks at sort of various demographic characteristics and performs a t-test, etc. And given that endogeneity is such a common concern in this kind of framework, I think it'd be helpful if you could see a broader discussion, more systematic discussion of the correlation between various kind of demographic characteristics and NPIs in a more central part of the paper. So for example, instead of just providing the balance test, independent balance test for various kind of demographic characteristics for below median and above median NPI areas, we can alternatively, think of just running a regression of the NPI duration on a whole bunch of demographic characteristics and perform an F-test and various kind of other more advanced documentation of the relationship between demographic characteristics of the areas and the NPIs that they have implemented. So that's the sort of additional discussion of the predictors of the NPIs I would want to see. Another sort of room for improvement that I want to propose is the concerns on the nonlinearity. So one of the reasons why we always have this lingering concerns about regression framework, even in the situation where we have lots and lots of controls, is because of this possibility of unknown nonlinear relationships between control variables and the independent variables. So I would want to see more sort of robustness checks associated with nonlinearity, especially for the key predictors of the NPIs. And another concern, the standard concern we may want to address is the unobserved factors such as political orientation. So it is pretty well known that in the US, the cities or the group of residents with different political orientation tend to have different implementation of policies, and they also tend to behave very differently in terms of the social interactions. So it leaves this lingering question of how the cities with long NPIs and the cities with very short and weak NPIs had different political orientations, how their social interactions might have been different, etc., or what is how their social structure in terms of the city of the structure differs across different sort of policy areas. And if you actually look at the set of cities that have been used, those cities are actually quite heterogeneous. So if you look at these 43 cities included in the data, you can see like really well-known cities that everybody knows of, such as New York, Los Angeles, San Francisco, etc. And there are also some relatively unknown, less known cities, such as Fall River and Grand Rapids, etc., that a lot of Americans would not be very familiar with. So it begs the question of what is the sort of what is the big picture of the geographic variation in terms of implementation of the NPIs, and also it's kind of noteworthy that there are actually very small number of West Coast cities. So in the earlier slide, we had a discussion that the cities with long NPIs tend to be West Coast cities. And if you actually look at the list of the cities, there are very small number of West Coast cities like Los Angeles, San Francisco, Seattle, Spokane, etc. So it makes us wonder about the geographic details of in terms of whether there's any sort of a small set of cities that actually drive the result, and if a small set of West Coast cities that contributed strongly to the results, what are those cities and what happens, etc. So I know that the author provides some discussion of sort of robustness in that dimension. I think what I would want to see more sort of clear and succinct, prominent discussion in the main body of the text. Another concern and room for improvement that I want to propose is the potential sort of confounding factors. So the discussion of the mechanism relies very heavily on the publication by Gostick, published in Science 2016. And if you actually look at this paper in Science, these authors have very specific discussions about which strain of the influenza is related to. So the exposure to which strain is related to the immunity to what strain in the future. So in Science paper, the discussion of the linkages between exposure to a particular strain and immunity to another strain is very, very specific, which is not what I see in this paper, which is to some extent understandable given that this is more of an economics paper rather than sort of medical paper. However, it makes us wonder what is the sort of the detail of the mechanism. So, and this is not only the question about the mechanism, this is also about, a question about the potential confounding factor as well. So first, given that the cities that had very strong NPIs had certain demographic characteristics, and they were located in concentrated in certain areas. It makes us wonder whether the strains that came later that were quite lethal had a certain geographic distribution and affected certain age groups a certain way. So the central question in thinking about confounding factors and mechanism is how much do we know about the geographic distribution, contagion, and the lethality in terms of across the different age groups for these future strains that affected the mortality in the subsequent years. So that's the information that I want to see ideally, but I'm not saying in the current version. So I want to see it in the future version of this paper. So this geographic sort of distribution and the age group affected by future strains that could potentially be linked to this 1918 strain. It is more of a question of the confounding factor. There's also a more sort of deeper question of the mechanism. So given that the science paper, the paper in Science had very specific discussions about linkages across very particular strains, it begs the question of what is the sort of known biological linkages, medical linkages between particular strains that are very active in 1918 and 1919, or subsequent years. And how much do we actually know about the sort of contagion and various kind of epidemiological aspect of these future strains that we are not tackling in detail in this paper. So that is the additional discussion that I want to see to sort of clarify the mechanism that is proposed in this paper. And the last question is a broader question. So the motivation of this paper was a little bit ambivalent. So the motivation of this paper started with a sort of very broad discussion of the importance of the great interest in the current pandemic and how understanding the past can be very helpful for understanding the current pandemic, etc., which most of us would agree with. But at the same time, there's a sort of very ambivalent argument that what we learned from this 1918 strain probably wouldn't be very applicable for the current pandemic, given that this coronavirus is affecting the age groups that are very different, and the medical technology that we have in the present is very different, and also the NPIs that we had in this year, in the past year, is very different in terms of the strengths of the lockdowns, etc. So the NPIs in 1918 were very different from the NPIs in the past year. So the motivation and the discussion about the external validity is quite ambivalent, and I want to see more sort of coherent sort of take on the external validity of what you can learn from this paper. So overall, this is a very interesting paper, and there is some room for improvement in terms of the discussion of the predictors of the NPIs, confounding factors and mechanism, and broader implications. And I'd be very happy to move on to the next discussion.
Yes, thank you very much. And the sake of time, please, let's do that immediately. The next discussant is Eric Hornung. Eric, the floor is yours.
All right. Thanks so much for putting me on this panel and for assigning me with the task of discussing this super interesting paper. Let me reiterate a bit of what you said. This paper studies the medium-run impact of the non-pharmaceutical interventions that were adopted during the 1918 influenza pandemic across US cities, and the impact on mortality and health outcomes. So far, it deviates from the existing literature and thereby contributes to the literature by providing us with a more long-run perspective. It has been around papers that have been looking into the immediate consequences of the influenza pandemic on health outcomes. There have been papers around that look into the medium run consequences for the economy, but there's no paper around so far, apart from this paper, that looks into the medium run consequences for health outcomes. The author uses, in my view, state-of-the-art econometric techniques. He looks into panel data with fixed effects. He studies event studies, and he contributes to the literature and to the existing data by adding new data sets, including monthly and weekly data on death counts and annual data on death counts by age groups, which is very useful to advance this literature. Now the author, and I think that like my discussion will focus mostly on this, the author argues that stronger NPIs, via their effect on mortality and contagion reducing effects, reduced individual and herd immunity, leading to a higher vulnerability of groups and individuals when the flu reoccurred and via comorbidities with other diseases, and thereby significantly increased the number of deaths in subsequent years in places that adopted stronger NPIs. So I think that's an important issue here, because in doing so, this paper addresses somewhat of a pertinent policy issue that we're not able to address with current data, right? We're still in the middle of the pandemic. We don't know what's going to happen once we're able to lift our stay-at-home orders and NPIs in a stronger fashion than we are able to do right now. So the question is, what are the consequences of NPIs on health outcomes in the medium run? So if we want to draw parallels with today, I think, and that's what we're here for, I guess, it's clear that we already now find relatively low or extremely low rates of other diseases due to non-pharmaceutical intervention. So if you look at respiratory diseases like the usual flu, the seasonal flu that we experience since the Spanish flu today, the positive tests have decreased from more than 20% to about 2% during the last flu season. Yeah, so that's an historical low already. So the question is, can we really draw parallels between 100 years ago and today? And in my view, this is kind of a discussion that we have to do about mechanisms. So if indeed the results in the papers are driven by a differential immune response or herd immunity, then the current situation is a lot different, because we are developing and adopting vaccines much quicker than we have in the past. And then the situation is fundamentally different, because we are not relying on immune response, but we can just basically vaccinate the population, reach herd immunity via vaccination. If there's instead different mechanisms at play, then they're interesting, and we need to discuss and understand them better. And here's where I come in, and because I think what this paper is lacking a bit, and what I can help a bit with, I guess, is giving him some perspective from economic history. So the paper currently doesn't do much about other than using historical data and not contributing much in terms of what the historical experience indeed was. And I usually advocate for doing this. I think context is important for understanding historical events. And I'm convinced that this paper can benefit a bit from that. So especially the discussion part that comes towards the end of the paper would probably benefit a little more from discussing different mechanisms than just focusing on the one that you're advancing and providing evidence for that. So what I want to do is kind of give you a bit of a standard economic history talk here and provide you with pictures and some ideas of what potentially have changed. So what are my thoughts on competing mechanisms? If you look into the secondary literature, it becomes quite clear that the influenza pandemic worldwide was an extreme event that shaped people's minds. So it might be that places with lower NPIs experienced much higher mortality rates, and that seems to be clear from the literature and also from your findings, so that the experience is much more extreme in places where lower NPIs were implemented. So maybe there's a learning effect, right? So there's more extreme experiences which for medical staff and affects their future behavior with respect to infectious diseases. It may have had an impact on the role of women in health, for example, right? So we're in a time period when a large part of the medical staff, the physicians especially, the men, are away at service at war. So one example from Philadelphia I found is that 26% of the physicians are not in Philadelphia, but are actually in Europe for World War I. So that women started to assume a different role than usual in not just taking care of patients, but actually trying to adopt different measures. So on the left-hand side, you see this advertisement for becoming a nurse, which seems to be more frequently adopted after the pandemic. So these schools for nursing were found in Chicago, for example, right after and during the pandemic. There might be other responses from the public health side. If you look into the literature, you find that New York was pretty well prepared for the pandemic because they had a very good public health system. This can be captured by a fixed effect. I'm aware of that. But if there's a differential response to that, it could be that cities that experience higher flu mortality rates just adopted different policies to improve their health system. So for example, again, New York, streets are more clean than often, public transport is better ventilated than earlier, and schools remained open during the pandemic. Not because they didn't care about their children, but because they argue that children were supposedly better monitored for illness in schools than at home. So that all of these results are in line with the comorbidity that you find in your table 7, and they're fully compatible with the mechanism that you argue for, and but also that the ones that I might advance here. The second part on mechanisms would be that potentially there's differential behavioral response from the population. So on the left-hand side, you see educational information from the Department of Health in New York. They inform you about the use of tissues for coughing and sneezing, keeping away from crowds, that you shouldn't spit on the floor, and that you shouldn't share drinking cups. So these are main issues that they inform you about. These are educational things that might sink in and might be adopted by a population also in the longer run in places that had a more extreme experience with this flu. So it could be a stronger shift in behavior in these places that experienced a stronger mortality during the October-November flu. It could also be a behavioral response that people in places that were experienced a stronger mortality started to relocate within the city, so have within city migration. So far, you only take care of international migration towards the US in your paper, but you just go and seek for less crowded housing, which is a super strong issue in these days, for example, in New York and Philadelphia and so on. It's hard to assess quantitatively, I know that, but at least it should be part of the discussion if you cannot do something about this quantitatively. Real quick, 2 more issues. The denominator, you talked about this, you do a lot already for the denominator. Still, there's always the issue that you might have measurement error in the population. So here's one example of the population estimate in Philadelphia in 1918. So officially, the count was 1,700,000 by the federal government. However, if you look into the Department of Public Health and Charities, they estimated actually 300,000 people more in the city due to war industry. So if there's differential war industry in these cities, it might be actually the fact that they need to be open more. They have lower NPIs, and it might differentially affect the denominator, which then also changes once the war industry is done. Nearly every home had lodgers in Philadelphia, so that affects crowding. So this is certainly an important factor that you shouldn't easily disregard. Other papers have used data by Garrett on war industry that can be a simple dummy, or other things that you might want to somehow account for. And then finally, just let me end on this real brief. It would be awesome to better reconcile the results with the existing literature on medium run consequences. So the Correa paper finds that there's better economic outcomes in places with NPIs. This is mostly high manufacturing employment. So it might be interesting to think about labor scarcity, wage growth. There's a paper by Garrett, 2009, that you're not citing, that argues that NPI cities had, or cities with higher influenza experienced higher wage growth. So it would be interesting to figure out how these cities fared after 1919. And that, without further ado, I'm going to stop here and give.
Okay, thank you very much. Unfortunately, we're already much into the discussion time, so we have something like 11 minutes left for questions and answers. Maybe I give back the floor to the speaker, to Guillaume, and then see what's left for questions that might be raised.
Okay, thank you very much. So I try to. There are also some comments that were asked in the chat, but I think that there is some recovering with what was said by the speaker, so I will try to address both. So thank you very much for those very helpful comments. First, this is really helpful and very nice from you to spend time on this paper to give me all those feedbacks. So. I will try to start addressing by order, so I will try to address Claire's paper, Claire's comments, which is what are the key. The first one was, if I remember, what are the key predictors of NPIs, basically. So here, really, and this relates with. I will directly try to connect it with another comment on the geographical details. So actually, the key predictor is really geography, or where are the cities located, and this is really well reflected when I introduce those shocks, those regional shocks. This is what affects the most the coefficients, because there is some collinearity between NPIs and the regional dummies. So yeah, I think I can definitely do that, like put a regression and showing maybe try to compute as well the explanatory power of both demographics and the geography. So and on this particular point, you stress the importance of non-linearity. I think that I tried to, as the main factor is geography, those are dummies. So basically, I think here non-linearity is already addressed, because I have different dummies for different regions. So there is no linearity assumption behind. Of course, then when looking at the demographic structure, I also try to look at within age groups variations. But maybe I can do even more, as you suggested, and try to look at some heterogeneity also following the age bins. I guess this is what you had in mind, or so yeah, for sure I could try to do that, even though I'm not so I think I did some of this and I didn't find many heterogeneity, but I can definitely try to say a word or get more details on this. Then there was a question about the so here I answered a third question in the end, because you already asked for this heterogeneity, and then you asked for the I think your second big comment is about the strain, the linkage with the strain of influenza. I think I discussed this a little bit, as I said that maybe it's not big. I think there is direct. So what stressed the literature is that this particular influenza, the 1918 one, then it gives birth to many strains that actually were dominant up to 1979 or something like this. So this is, I think, one key factor to explain what this was key. Even though, but then I don't know what I could do. I can discuss this probably more, but as far as robustness check to do, I don't exactly know what I could right here, because there is no clear data on the strains. Like just there is one single paper that finds some corpse in Alaska having contracted the flu and that sequenced the virus, but this is a full paper for one strain, and which there is very few biological evidence on the different strains and their characteristics that succeeded one year after the other and in the different cities. So I might try to dig a little bit deeper in this direction, but as far as data are concerned, I'm afraid that I will be a little bit limited. And finally, you had another comment on what are the motivation, the implication for nowadays. And I think this rejoins some comments by Jérôme Ada and some discussion in the chat that highlighted that, yeah, maybe there are some countries that should be aware of those results because it has direct implication on their need to vaccine. And maybe also one key takeaway of such a study would be that one should not give up, because I think virus come, then they mutated, then you can turn to a mutation of the COVID-19. I guess it will be called COVID-22 or something that will be probably at some point less lethal. And so that we won't see as obviously, and people will just probably stop get vaccinated. Whereas this is a risk, because then they could even contract the next strains without getting vaccinated, and then probably see their life expectancy reduced by those mechanisms that I'm trying to discuss. And so I think this is a concern, because we think that this is like the 1918 pandemic. After October or after December 1918, people thought about something else, where, well, at that time there was no vaccine, so not much to be done. But nowadays, try to also convince people to get vaccinated every winter against influenza is already a fairly relevant policy dimension. And I think this results stress that it should be also the case in the future as far as COVID-19 is concerned. And finally, so now I'm going to move to Eric's point. So thank you very much as well, Eric. So I guess I have three main takeaways. Well, I guess you expect some answers. So the first point is on health expenditures. This rejoins very closely a comment by Gabriel Fac in the chat, where you ask, can we do more about health expenditure? So here, I guess, yeah, I had this in mind actually. So it was already stressed by the referee in the first rounds. So I already have some results. I investigate where there is no substitution between health expenditures, public health expenditure, and the placebo test, that I do not find anything. So you suggest to go further and look at public housing and EGN. So I can try to dig deeper and try to find some data on that. And maybe your nurse story might be also extremely interesting, or even doctors. Maybe I could look also in my placebo test. I guess you have the profession of the people in the census, in the microdata. So I might try to look at whether there is a statistical association between the number of nurses or the doctors with NPIs, and this might probably be an advance for the paper. I don't know what you could think about, or whether this would be satisfactory, but maybe I could try to look at this. Then you have the behavioral response, and here this would be harder to. I can discuss this, but data on the way people used to behave, I don't know. I tried to find some survey, but I'm not sure at that time they were very precise survey on those kind of practices. But I might for sure add a discussion on this potential explanation, even though in the end it's hard to, because in the end it's something more psychological. So because one might think, okay, cities that were experience higher mortality then will behave better. But in the end, it's the net impact when you reach the end of 1920. There is there is not so clear difference in excess mortality between high and low NPICT because of the mechanism I put forward. So yeah, I guess it should be the excess mortality which is traumatic, like the very violent one, that I should try to control for, maybe to see whether the effect disappears when controlling for this, or reduce at least. But then I guess this would be very collinear with my treatment. So I don't know whether there is an econometric way to disentangle both. And finally, the population errors. So here you suggested the avenue to deal with this additional war industry worries. So I will just try that. Thank you very much for this suggestion. Even though I think that, well, what I might think of is that my pre-trend go back to even before World War I. So we don't see so if there was a sudden increase in workers that tended to die at that time and then went back, we should observe something like before even, like when the US entered the First World War. But this is definitely easy to check, so I will definitely have a robustness check on that. Thank you very much. I hope I answer all the questions. I see I'm running out of time totally, so I hope this was satisfactory.
Okay, thank you very much. This is pretty much a precision landing in terms of time, and I also have no list of additional questions that came up. So I used the 1 minute left to inform you something about which Mariolina informed me. We have to stop sharp at 4:30 because of the upcoming meeting later on. And I should remind you that this other upcoming meeting, you need different accession coordinates for Zoom. So if you don't have them in your machine or in your memory or elsewhere, then please contact Mariolina. She promised to be of help in case. That's about, and I should remind you that we continue tomorrow at 12. So this is not the end today if we stop at 4:30. And we move on to the next presentation, which is on can the COVID bailouts save the economy? And this paper is presented by Tim Landvogt. The floor is yours.
All right, thanks a lot. Let me, all right, well, thanks a lot for giving me the opportunity to present this paper. This is joint work with Vadim Elanev and Steinman Nuremberg. And as you just said, the question is, can the COVID bailout save the economy? So more precisely, what do we mean by this? So, you know, as everybody's well aware, the coronavirus pandemic basically forced major economies to shut down large parts of the economies. And many businesses were kind of bound to fail without government assistance, right? So they would be unable to pay wages, their fixed costs, for example, rent or service debt. And we know that especially small firms have only small liquidity cushions, and that those would be quickly exhausted. So then there's the natural danger that a corporate default wave, so defaults by these firms on their outstanding debt, would then lead to trouble in the banking system and basically would break the financial system, and you would get some sort of doom loop of corporate defaults causing bank failures and intermediary failures, which then would further dry up credit supply and so forth, right? So once insurers and banks fail, you get spillovers to other credit markets. So, you know, policymakers anticipated this problem, and both in Europe and the US, there were large government interventions to support businesses. And we're going to specifically focus here on the US response. So there were basically large direct lending programs as part of the CARES Act in 2020, the Paycheck Protection Program, the Main Street Lending Program, and various corporate credit facilities managed by the Federal Reserve. And the question we're asking is, how effective are these policies, or were these policies, at preventing a large corporate default wave? And also, what are the long-term fiscal costs of these policies? Okay, so how are we doing this? So we're basically going to use a macro model, a dynamic general equilibrium model, to quantify the effectiveness of these lending programs by comparing them to a counterfactual do-nothing scenario. And how we're going to do this is we're going to base this on some previous work. So the same as my co-authors and I have some previous published work that I'm just going to refer to here as ELBN. And in that work, we developed a macro model with firms, intermediaries, and the government. And we're going to use this framework and map these coronavirus relief programs into this framework one by one and also combine. And then we're going to analyze the macro financial and fiscal impact of the COVID shock in combination with or without these policies. And so just to give you our main finding up front, so what we find is that these programs really soften the contraction by mitigating roughly 40% of corporate default. So we see a 1/3 smaller drop in GDP and consumption along the recovery path than we would have seen without these programs. We find a 50% smaller decline in investment. And we find that absent these programs, 25% of intermediaries in the US would have failed. So we would have seen a large banking crisis. And you know, even though the government spent a lot of money on these programs, we also find that effectively there would have been a similar rise in government debt without these programs, because the government would have had to spend similar amounts of funds on bailing out failing banks if they had not bailed out or helped these companies up front. And you know, another detail is basically that we find that guaranteed forgivable loans, such as were used in the Paycheck protection program, are most effective. And these corporate debt secondary market interventions only have a small positive effect in our model. And we also look at how better targeting of these programs could have greatly reduced the fiscal cost. Okay, so what are these programs that I'm talking about? Just quickly some numbers. So the one that most people are familiar with is this Paycheck protection program. That was roughly 3.1% of 2019 GDP, so a large program. What this program entailed were 2-year loans that were given to firms at 1% interest. And if these firms used the loans to fund payroll expenditures, these loans were up to 100 or are up to 100% forgivable. And the institutional arrangement is that banks originate these loans, the Fed provides the financing, and ultimately the Treasury guarantees these loans or forgives the loans. Another program a similar program was the so-called Main Street Lending Program. This was targeted at slightly larger firms. And it was also a loan program, roughly 2.8% of 2019 GDP. There were some differences. So in this case, banks would originate these loans, but they would have to retain a stake in these loans. So only a certain fraction, only 85 to 95% of these loans would be guaranteed. The interest rate is higher. It was tied to something like LIBOR plus 3%, and there would be no principal forgiveness. And then there were these various corporate credit facilities. So these were also large in terms of magnitude, at least in the original design of the program. And they consist of different facilities aimed at the largest firms, and they involve purchases of bonds in secondary or primary markets. So not direct loans to firms, but basically purchases of corporate bonds by the Federal Reserve at market interest rates. Okay, so what we're going to do is we're going to take these programs and we're going to try to map them in our model. And as I hopefully can kind of show you a little bit, our model is a good laboratory to study these programs. Now, I don't have time to give you really details on the model, so I'm just going to give you a very high-level overview. So this model is a dynamic general equilibrium model. It has 2 types of households, borrowers and savers. Borrowers are also the less risk-averse agents in this economy. So they're the stockholders. They participate in risky asset markets, whereas savers only hold relatively low-risk assets. So borrowers hold the equity of both producing firms that produce consumption goods and hold the equity of financial intermediaries. Now, these producers borrow risky debt from intermediaries. And these intermediaries, in turn, fund this lending to producers by issuing equity and deposits to households, with the equity being held by the stockholders and with the deposits being held by the savers. And it's important that there's default risk for both of these institutions. So both producers can default on their loans, and then if lots of producers default on their loans, the intermediaries might get in trouble and these intermediaries might default. And you can get what we call a double financial accelerator, where basically these 2 credit frictions can kind of feed on each other, right? So if lots of firms default and intermediaries get in trouble, they cut back on credit supply. That makes borrowing harder for firms, so even more firms default and so forth. And then there's also a government. Now, the government in this model basically provides deposit insurance. So if an intermediary fails, the government will make whole the depositors, and they will pay for these bailouts by raising taxes. Okay, so that's a very high-level overview of the model. So now, what do we do with this? So we put in what we call a COVID shock, right? So in order to understand how the shock works, let me just tell you that in our model there are 2 exogenous aggregate state variables. One is a very standard TFP shock. So this is just an aggregate productivity shock. And then the second shock is a dispersion or uncertainty shock. So there's a distribution of firms in our model, and these firms receive idiosyncratic productivity shocks. And there are certain times when the dispersion of these idiosyncratic productivity shocks goes up. And then in our previous work, we show that a transition to a low average TFP combined with a high uncertainty shock can generate deep recessions triggered by this double financial accelerator. And we call these recessions financial crises or financial recessions. Okay, so then this COVID shock that we're feeding into the model is basically this. So the first component is basically a transition into this financial crisis regime. But then we pair this with several other components that are MIT shocks, so they're not anticipated by households. So first of all, we make the uncertainty component, this dispersion, even greater than during kind of a regular financial recession. This is the second part here. Then we also lower the average firm productivity by even more, such that GDP drops by 3.5% in the first year this shock hits, right? And so this is matched to the drop in US GDP in 2020. And then the fourth component is a little more subtle. This is what we call a transition to the new normal. So in the baseline version of the model, agents do not anticipate that pandemics might occur, right? They don't, this is unexpected for them. But then once the pandemic occurs, they kind of update their beliefs and they realize that from now on, these pandemics might reoccur, right? And so this is kind of the new normal where they realize, okay, pandemics are now a risk that I have to take into account. So there's also this shift in expectations, and that's the fourth part of the shock. Okay, now why this combination? Well, you know, the low productivity just basically captures these economic shutdowns. It's a supply shock. So we had a different version of this where we were feeding in a large exogenous reduction in labor supply. That looks very similar in our model. Both are basically large supply shocks, so we're just going with the mean reduction here. And then the additional dispersion that we find is basically captures the fact that, you know, we saw a large average decline in productivity, but we also saw a large increase in dispersion. So some firms actually benefit from the coronavirus pandemic. Think about grocery stores, large technology companies, or pharmaceutical companies, whereas others really suffer. So basically dispersion and productivity goes up a lot too. Okay, so now let me tell you how we map these different credit policies into our model. So for that, it's important to think about the timing. So here's basically 3 stages within each period that happen. First, aggregate TFP shocks get realized. Then firms choose labor inputs and they have to pay fixed costs. Then idiosyncratic productivity shocks are realized and production takes place. And at this stage, firms might liquidity default. And then failed producers are replaced by new producers, and producers who didn't fail can access dividend capital in equity markets. And so this timing here is important, right? So this stage 2 is critical. That's basically the critical friction in the model. Basically, firms first have to service old debts and pay wages before they can access capital markets. That gives rise to liquidity default friction. In particular, the profits at this stage 2 are whatever the firm earns by selling the output goods minus the wages they have to pay, minus whatever they have to pay to service the outstanding debt, and then they have to pay some fixed costs that are proportional to the scale of the firm. So this profit basically gives rise to a default threshold such that firms that receive a bad idiosyncratic productivity shock that is below this threshold will default. And this is simply what the threshold looks like if you do the math. Now, how we model these policies is through so-called bridge loans. Let's say banks extend a loan proportional to the wage bill to a firm at stage 2 in this process. This loan then needs to be repaid with interest at stage 3 and is junior to the old debt that the firm has. So if this loan is proportional to the wage bill, and here's this proportionality factor A, what this means is you will lower the default threshold because these firms will now have additional liquid funds that they can basically use to bridge this cash crunch, right? And so that's how these bridge loans work. By extending these loans to firms, we can lower this default threshold. Okay. Now, as in real-world programs, in our model, we're capturing several features of these bridge loans. In particular, the government can guarantee a fraction of these loans for banks. It can forgive a fraction of these loans for borrowers. and both policies can be partial and interact. And then, you know, what we're doing is we're basically feeding the magnitude and the institutional features of these programs that I've given you in the beginning. We're feeding them into the model, combined and separately. We also consider something that we call a conditional bridge loan program. This CBL program is basically a theoretical benchmark. It answers the question, if the government could perfectly target these loans at those firms who are most likely to default, right, then, you know, what would be basically the ideal policy response? So this is more kind of a benchmark at, you know, how good could we ideally do if we had perfect information who to target these loans at. Okay, so let me jump straight to the results. So this is just the effects in the first year of these programs. So here you see different outcome variables and, you know, what this variable does in the first year the program is implemented. And there's always a benchmark scenario that we call no COVID policy. That's if the government kind of did nothing. And then there's the different programs. The combo program is a combination of all the programs, and CBL is this ideal theoretical benchmark. So what you can see is that the Paycheck protection program, this Main Street lending program, significantly lower the default rate, and they do this enough to stabilize the intermediation sector. Right? So absent this program, there would have been close to 25% of intermediaries defaulting, but with these programs, only much fewer banks default, and this is because much, you know, there's a big reduction in the default rate of firms. Right? Okay, so then we also see that these corporate credit facilities, basically these purchases of bonds in the secondary market, are ineffective at lowering defaults, and there's only a small price effect that lifts intermediary assets. And the combo program, combining all these programs, leads to 1 percentage point smaller loan spread, and we can prevent 4/5 of intermediary failures. The perfectly targeted CBL benchmark prevents, by design, almost all defaults, and that's much better in that respect. Now, what about welfare? So what you can see is our shareholders' borrower consumption falls by roughly 14% in the no COVID policy case. So these, and you know, you can see with the combo policy, their consumption falls by much less. So these borrower shareholders, they benefit greatly from these programs. Saver consumption moves inverse to investment here, right? And so this is a case, this is one of these borrower saver models. So when the financial system breaks down, then the savers cannot save anymore. Basically, the flow of funds to this financial system is impaired. And so they have to consume instead. So that's why their consumption goes up. But, you know, in aggregate, you're going to see declining consumption. And then we can basically aggregate the welfare of these two households using a consumption equivalent measure. And we can see that households are willing to pay roughly 1.5% of pre-COVID GDP for this government combo program. So, you know, there's a clear welfare gain. And interestingly, the welfare achieved by this combo program is close to this ideal CBL program, despite the imperfections of the program. Now, what's the fiscal impact? So this is a legitimate question, right? So basically, you know, the government spends a lot of money here. So if the government pursued none of these policies, we would still have a cost of 7% of GDP for intermediary bailouts, because so many banks would fail. So you'd have to bail out the banks. The combo program instead costs 10% of GDP. So we only find a 3.5% higher primary deficit with these large programs than we would find if the government had done nothing, because the government would have had to spend the money on bank bailouts. The model also predicts a large rise in safe interest rates from this massive increase in government bonds, as you can see here. So safe interest rates would decline a lot more in the in the no policy case than they do in the combo case. Okay, here are the fully dynamic effects. So these are basically impulse responses to the shock. So this is the no policy scenario. So you see, you know, absent any kind of policy intervention, this would be bad, right? We see a large persistent decline in consumption and over 50% drop in investment, a very large increase in government debt, and so forth. Now, the combo policy basically is very effective because it prevents this very large drop in investment, and then along the recovery path, we have a much lower drop in aggregate consumption. In particular, there is a 7.3% cumulative consumption gain along this recovery path from these combo programs. If we implemented the ideal CBL program, we would get an even smaller drop in investment and even, you know, even bigger Now, finally, in my last few minutes, a few words on the long-run consequences of this pandemic, right? So what we can do here is we can compare kind of the stationary, the steady state of this economy pre and post-pandemic. And so a lot of this is driven by agents now updating that these pandemics are a risk that they have to take into account, and basically, a potential recurrence of these pandemics, even be it in, a long time from now, affects their decisions already today. Okay, so what we find is that this post-pandemic economy going forward is going to be characterized by less firm debt and leverage, because borrowing now became riskier, a smaller but higher leverage, a smaller intermediary sector with higher leverage. We're going to find that more corporate debt is held outside of intermediaries, so in the form of corporate bonds. And we find on average slightly lower GDP and consumption because basically the financial system is smaller. And households would be willing to pay 2.8% of baseline GDP once to avoid living in a world with pandemics, right? So if you ask households how much would you be willing to pay to avoid future pandemics, even though there are these very rare events, they would be willing to pay a relatively large fraction of baseline GDP. Okay, let me conclude. So what I've shown you is this quantitative model that we can use to evaluate these government lending programs. Overall, we find that these programs are very effective at short-circuiting a financial sector collapse. And this off-the-charts downturn of the do-nothing scenario basically remains counterfactual thanks to these interventions. A model has a pretty tight mapping of real-world programs to the model. I don't need to go through the detail. The model predicts a 15 percentage point rise in primary deficit to GDP. But bailing out the financial system would cost almost as much. There are several extensions we could consider of this, but this is what we have so far. Thank you.
Okay, thank you very much. Let's move on. We have two discussants again. Edouard Chalet, the floor is yours.
Thank you very much. All right, so hello everyone. I was delighted to prepare this discussion. It's an impressive paper and model. So what I'm going to do in this discussion, I'm going to try to disentangle what are the really key elements of the paper. So Tim has done some of that with his high-level presentation of the model. I'm going to do a bit more of that. I think it's going to be useful because the model has many moving parts. And then I'm going to offer some general comments, which are no critique of the model, but rather fruitful thoughts. Okay, so it's a very rich, dynamic, stochastic general equilibrium model that is used to answer the question of the COVID bailout. When faced with the complex, rich ESG model, it's useful to disentangle what are the main ingredients that generate the key interaction from a theoretical point of view from the more peripheral assumptions that basically are there mostly to improve the fit of the model and to make it quantitatively meaningful. Okay, so let's do this distinction here. So the model, the key elements are the financial frictions that are built in the model, financial frictions that hit both firms and intermediaries. Okay, so this is a distinguishing feature of that DSG model relative to the other DSG models of the COVID crisis that have been around. So what are those frictions and what feature do they generate? So on the side of firms, we have a leverage constraint that generates a financial accelerator. So this is fairly standard. It's a feature of first generation models of financial frictions where basically the difficulty of firms in financing themselves will feed themselves, generate low cash flows, low asset prices, which will tighten the constraint and so on. So there is already a feedback loop that is built in. what is added to that dynamic is idiosyncratic shocks in addition to productivity shock. And the purpose here is to generate cyclical default rates on long bonds issued by firms, and therefore cyclical spreads, credit spreads. Okay, so as Tim explained, because the distribution of those idiosyncratic shock has full support, there is a threshold, and firms that fall below this threshold will be hit, will go bankrupt for liquidity reasons. And that threshold will be moving over the business cycle, okay, because of aggregate shocks. So the two are important here to get this outcome. On the side of intermediaries, there is a capital requirement, which basically is going to be making credits, the ability of the intermediaries to gather funds for lending limited. Okay, so we're going to have this also some kind of financial accelerator on the side of intermediaries, coming from the fact that that distribution of credit is limited by borrowing, by deposits, which will, as I will explain a little bit more in a minute, feedback on firms' cash flows and repayment and so on. And there is limited liability, so intermediaries can default. They can default. They can choose to default if their net present value goes negative. And there is a idiosyncratic shock, so that some will default and some will not. Okay, so we're going to have cyclical bank default in addition to cyclical firm defaults, and that's another key element of the paper. And on the other hand, so we have firms, we have intermediaries, and at the very end we have those savers who face a portfolio choice. They hold both riskless assets. So I forgot to say, the intermediaries issue safe deposits that are guaranteed by the government. So they are part of this portfolio of safe assets of the savers. Okay, and then so these are the key elements, and there are some more peripheral features that will improve the feed, that will generate plausible investment dynamics, plausible variability of credit spreads, and so on. But they are less central to the key feedbacks. So I'd say that all these ingredients have been around in the literature, so none of them is individually new, but the model blends them in a unique fashion. So as Tim explained, there is this double financial accelerator. So there are two feedback loops already built in, but they interact and they lead to even more amplification that you would have with the elements separated. It's not always the case that when by mixing two frictions, you get more than the sum of the two parts, but this is one of the instances where it arises. Okay, so you can get large effects out of relatively limited variations in the aggregate state, in the exogenous aggregate state. And this shows up in strong non-linearities that are preserved by the solution method that the authors used. So the model originally was developed to understand cyclical capital requirements, basically the fact that the usual trade-off that policymakers have in mind, that tighter capital requirements will limit funding, but they will make the banking sector more robust. Okay, but indeed it has all the ingredients that help us think about important policies that have been put in place during the COVID crisis and that have been neglected by the literature. I think the literature has mostly focused on policies aiming at protecting the households rather than those bailout policies directed to firms. Okay, so I'm not going to go over the policies which were quite well described already. And there is a COVID shock, which is in fact a mixture of shocks that gives an important role to uncertainty. There is and here dispersion is not exactly the same as uncertainty. Dispersion is the actual productivity dispersion, and it's going to affect the threshold and the fraction of firms that default. And uncertainty is future dispersion and how it affects spreads and therefore portfolio choices ex ante. But the two are playing out here. So we have a fairly a good representation of bailout policies directed at firms, and that is great. What wasn't so clear to me is why, so the model could accommodate other policies that were in place as part of the big bailout program that were concerning other agents in the model, like intermediaries and households. So, for example, capital requirements were relaxed. It seems to be that you could temporarily relax. You could have that in you could look at that very easily in the model. Regarding so this concerns the intermediaries. Another policy that concerns the intermediaries is the discount window lending. So I understand that in the model, intermediaries default because they have the possibility to default because of the limited liability clause. So they do not really default because they are hit by a bad liquidity shock. But you could have those shocks, I guess, fairly easily, just as you had them on the side of firms, and give a role to this discount window policy. Similarly, the 12th side of the bailout package was directed at small firms and households. It doesn't really have a clear role here. So in the paper, you kind of, if my understanding is correct, you're taking the amount of that policy and merge it with the corporate credit facility. But the corporate credit facility was directed at large firms. So I wonder if this wouldn't require specific treatment for that reason. So there are policies that clearly could quite immediately be incorporated in the model. Okay. So now the food for thoughts. The model is different from the existing DSG models of many other DSG models of the COVID crisis. There are not so many, but the others that I know of, in abstracting from the monetary dimension. Okay. And in particular, it abstracts from another feedback loop that arises when the zero lower bound is binding, where deflationary pressures feed themselves because they raise the real rates and therefore the lower aggregate demand, output, and that feeds back to lower marginal cost, lower inflation, and so on. Okay, so one question. So I think it's not so straightforward to introduce nominal rigidities in the model because it's quite rich already. But I wonder how the quantitative magnitudes would be affected by that. So the model here, the burden of the aggregate drop in output falls entirely on the drop in average productivity. Okay, so that's fine. The model matches the fall in output. But bailout policies would probably play out differently in a liquidity trap. For a given amount of dollars that you're ready to make, because the liquidity trap has specific dynamics, it would play out differently. So my guess is that because of this feedback loop, I would think of the estimates of those policies as a lower bound to what to their true effectiveness. So maybe what you gain actually is bigger than what you showed in the IRF. Another dimension in which the paper differs from what has been done elsewhere in the literature is that it focuses on firm level uncertainty as opposed to household level uncertainty. So some papers have, the papers that focus on the household side, and I've looked at how the bailout package provides better insurance to the households and therefore avoids precautionary savings and additional aggregate demand effects. Okay, so here the fact that house.
I'm sorry to interrupt.
I'm over time.
You have to come to an end. Yes, definitely.
Okay. So no, I will stop here. I mean, one thing. So when you focus only on uncertainty about firms, what happens is that households on impact move away from investment, they go towards consumption. So you can have an increase in consumption. That would not arise if you also had uncertainty on household income. And I will stop here. Sorry for having spent a little more time than I do.
Yeah, sorry, I was a bit afraid because you have 2 more slides to go.
No,
Thank you
yeah,
very much. Let's move on without further ado to Christina. The floor is yours.
I need to stop sharing, sorry.
Yeah, so thank you for the invitation to discuss this paper today. So the question is, can the COVID bailout save the economy? And let me start with why this question is important. So countries around the world have approved trillions of spending packages as a response to the coronavirus in order to protect people's health, but also to combat economic downturn. And there, which is more important for the context of this paper, there's a wide range of measures to address corporate funding needs. And this is ultimately to stave out bankruptcies. And there were for example, some indirect wage subsidies like the PPP program, which is at the core of this paper, but also direct wage subsidies like the expansion of access to short-term work or other components like, this was for example in Germany, like the coverage of minimum wages, which was implemented in France and other programs. So, but what we have to keep in mind that these governmental decisions had to be taken under rapidly changing epidemiological and economic situations. And of course, given that, the programs that had been in place differed a lot with regard to countries. And aside from the fact that countries differ in the position to finance the spending, funds were also deployed very differently. And what you see on this picture here is taken out of the Global Financial Stability report. And this is the direct support programs to corporate financing. And these represented between 3 and 34% of the GDP for the advanced economies, which are depicted here. But we know that size does not necessarily mean efficiency. And therefore, it is very important to be able to evaluate the effectiveness of these programs. And this model gives a theoretical framework and a starting point, not only for the evaluation of the programs in the US, but also in other countries. So in this environment, the paper analyzes the effectiveness of corporate loan programs in the US in a theoretical framework, but aside from the contribution based on the theoretical framework, the paper also provides rich institutional details, how these programs were implemented. And especially from my perspective, not being an expert in this field, it was a very interesting read. To evaluate the welfare implications of different policy interventions, the authors map out this extensive general equilibrium model, but I will not go into details here because it has been presented twice now. So my the first question that I have is related directly to the research question, which is stated in the introduction, and it is, how effective are the government's corporate loan programs in response to the COVID-19 shock likely to be once full developed? And given that this COVID shock is the new ingredient to the previous version of the model, we have to keep in mind that timing is important when it comes to a pandemic relief. And what I was wondering when I read this was how this implementation potential of the different programs affects the effectiveness. So given, for example, that the bridge loan programs involve an intermediary, so the banks, this might be important. So when you read criticisms, for example, about the PPP program, you find that so it has been criticized that it was too slow or too complex, that you had differences in the complexity of the application process. And the question that I'm asking here is not whether programs need to be implemented at all. This is clear, I think. But the questions I'm asking is whether how sensitive the outcomes of the model are to the implementation speed needed for different programs. The second thing I want to talk about is the longer and the long-term effects. And there the question is, can and should we bail out everyone? Let's frame it a bit in this, like, okay, it's not everyone, but almost everyone. Let's face it that way. So in the model, firms can refinance these loans after a year in the regular long-term corporate debt market. This is stated in the paper. Pushed bankruptcies levels even below the pre-COVID levels. And what I was wondering when I read this is whether this would imply a backlog of bankruptcies. So because the program might bridge firms that will nevertheless default, because they would have defaulted anyways, independent of the COVID shock. And given this, piling up these firms might lead to a bankruptcy boom once the corporate loan programs were off, and putting the financial stability at risk at a later point in time. And I didn't see a discussion of that problem in the paper. Now, given that I'm working in empirical household finance, I'm now coming to a different perspective on the bailouts. And the question is, should we bail out everyone? And what I mean with that is the paper provides a nice counterfactual, because essentially the counterfactual is either we bail out corporate loans, corporations now, or we bail out banks later. And this might be interesting also from a public perspective, because different programs might have different multiplier effects or moral hazard spillovers. And I'm not talking about moral hazard within the corporate sector, but within the public. And let me give you 2 examples for that. So the negative side effects of bailing out banks. So first I want to start with a paper of my former colleague Tobin Hansball and co-authors. What they showed after the financial crisis is that clients of retail banks where executives were prosecuted for misconduct were more likely to later, were 3 or 2 times more likely later to convict white collar crime. So this bailing out of the fraud here in this context had a spillover effect to household behavior. And in this context of bailing out banks, it could result in a negative sentiment towards capitalism. And I want to show you a figure of a paper of mine where we look at the effects of experiencing communism towards financial markets, which is a different context, of course. But what I want to show here is that there are negative sentiments against capitalism. So capitalism creates inequality or creates coldness. And these negative sentiments are correlated with stock market participation. So there could be negative externalities by banning out banks, which we are not aware of. And to bringing this to the point, the paper says essentially that the government is saving money by spending money. And the idea here is that it comes to the conclusion that these programs save money by spending money because it eliminates bankruptcies and saves the costs of bailouts later. But in addition to that, it could also have a positive side effect to bail out corporations instead of banks, with regard to the perception that people have on the way the government is responding to the shock. And I want to cite another paper here, which shows that, for example, so what they did in the paper is they surveyed 19 countries with regard to their perceptions of government responses. And what they showed is that people who agreed more to positive or had positive sentiments with regard to the government responses were also more likely to cooperate in travel restrictions, in closure with regard to the closure of schools, or with these stay-at-home orders, which we have talked about in the morning during Marta's presentation already. And therefore, I want to end with the idea that the bailing out of firms instead of banks could also have positive side effects on public perceptions on government responses, which may also influence public cooperation in other domains.
Okay, cool. Thank you very much. So this leaves us with 12 minutes in total for the rest of the discussion. We have something like a bit more than, I think, 16 interventions. It's a bit hopeless task. So I suggest I give back the word to the author, Tim, and ask him to address the comments and including the chat. And if he has spoken, then time is up, or at least he should have come to an end at 4:30. Please.
All right, well, thanks a lot. Well, I'm actually going to try to keep it relatively brief. Maybe then other people can still jump in with questions afterwards. So I think both in the chat and in the great discussions, thank you to the discussants, by the way, there were kind of certain themes that emerged. So one important question was around monetary policy. So in our model, there's basically the real model. There's really no role for kind of monetary policy, and clearly in reality, monetary policy plays a big role. So during this episode, central banks were basically stuck at the zero lower bound. So in our model, there is no zero lower bound. And as Eduard pointed out correctly, if you had a zero lower bound and interest rates could not go negative, as they do in our model during this crisis, you would find probably a much more severe crisis and a much more severe drop in activity without intervention. At the same time, then, because the interventions would have aggregate demand effect, right, at the zero low bound, you would basically find probably a much larger fiscal multiplier and also a bigger effect of these policies, right? That's what I would conjecture. Now, this is a conjecture. Simply taking a monetary side and a zero low bound and putting it into our already complicated model is very difficult. I mean, people who work with the zero low bound know that this leads to all kinds of complications around, multiplicity, numerical issues and so forth. So we've not tackled that in this paper. We are working on a follow-up paper that's about the long-term fiscal impact of these policies that does feature a monetary policy side. There, the question is going to be more about, can the Fed, in some sense, help, can monetary policy create fiscal capacity? That's going to be the question of that project. But we don't have that in this paper, and all I can do is have this conjecture that I just mentioned. Another question was kind of around debt weight losses. Right, so defaults, both of banks and firms, lead to debt weight losses in our model. But debt weight losses are only part of the story. There's basically two things going on. When these firms or banks default, there's some efficiencies and some debt weight losses. At the same time, there's basically an endogenous propagation, right? So even without these debt weight losses, because you get such a large drop in investment because of restrictions in credit supply, right? You get the debt weight losses basically play a role in the first period of this crisis, but then you get like all this persistence going forward because credit supply is depressed and investment is low, and that way the capital stock is low, and you get reduced consumption and output for a long period of time, right? So I think Dirk was suggesting doing a decomposition, and that's definitely something we can do. But both channels are there. One is basically debt weight losses hit the economy, that's the bad thing, and then you get propagation and persistence because of reduced credit supply and investment going forward. And then, a third point I was going to address is around kind of like zombie lending, as some people call it. You could also call it inefficient bailouts, right? Maybe some of these firms that are being bailed out should have actually gone bankrupt because they were, inefficient to start with, right? And so now we're kind of maybe creating some moral hazard here going forward because firms kind of bank on bailouts and so forth. To be honest, none of this is really present in our model. These shocks, these IID productivity shocks that firms receive are not persistent. These liquidity defaults in our model are basically always inefficient. And so, preventing these defaults is always a good thing. So we can't really speak to that trade-off. So there were lots of other questions, but I kind of wanted to leave it at these 3 points because I think those were the biggest 3 points. And then if there's other questions, and we already responded to some other questions in the chat. So maybe if somebody else still wants to jump in and ask a question, we might have some time. I don't know.
A big thank you to all presenters and formal and informal discussants. And I hope to see all of us later on or tomorrow.